welcome to the Roundup. We'll cover what's important to accountants and advisors that occurred across October. We'll look at the new draft ruling on individual residency, the ATOs 180-degree U-turn on income generated from fame and image. But first up, the federal budget.
We've got a new government that's released its first budget. Is there anything in there that tax advisors should be aware of or should be discussing with their clients?
Well, the short answer is not all that much, actually. This is a bit of an interesting budget because it's really just the new government kind of giving us a picture of how the economy is going and I guess some of the measures that they're thinking of in terms of allowing people to kind of cope with the reality of the situation. But from a tax point of view, in terms of the sorts of questions that advisors and accountants might be getting from their clients, we would expect that to be reasonably minimal this time compared to a typical budget. There are a few things that are tax related. Some of them had already been announced in the past, so it wasn't a surprise really in terms of the budget. Things like the FBT exemption for electric cars. There was already a bill before Parliament on that, so again, no surprise there. And the government referred to some additional COVID-related grants being made tax-free, but these were things that had been done previously, that had already happened quite a while ago. So there was nothing additional in that space that was really new to us. Some of the things that were announced as part of this budget that are a little bit different. First of all, the government has said that they will not be proceeding with the previous government's plan to allow you to self-assess the effective life of intangible assets. Now, the previous government had had a couple of goes at this. I think from memory, they'd kind of tried twice at least to get this change through Parliament. It had never got there, and the new government, the current government, has said that they won't be proceeding with that. So intangible assets that are subject to the depreciation provisions will continue to be written off, basically based on the effective life as given in the tax legislation. Although having said that, with temporary full expensing for small business entities, the write-off rates can certainly be a little bit faster. For those of you who have clients who are part of a multinational group, a cross-border or international group, there will be some things to keep in mind because the government is planning to tighten up some of the integrity rules that apply to multinational businesses and enterprises. One of those changes will be in the thin capitalisation space. Again, this was an announcement made as part of the election campaign, so it wasn't completely a new thing that we were hearing for the first time, but the government is wanting to modify the way the thin cap rules will apply, and that may well have an impact, practical impact, on the interest and other debt deductions that are claimed by some multinational groups in Australia. The government is also planning to tighten up, I guess, some of the rules in terms of entities making payments to related parties offshore for the use of intangible assets where those related entities overseas are in a no tax or a low tax jurisdiction. So the government clearly has some concerns with the way that some, again, multinational groups structure their arrangements, so that royalties and other payments relating to the use of intangible assets are basically creating a deduction in Australia, but then not being taxed at an equivalent in an equivalent manner overseas. So again, that's an area that the government is looking to tighten up. Now, one of the things that we probably didn't see coming was the announcement that there would be some changes to the share buyback rules for tax purposes, but these are quite limited in that they are aimed at share buybacks undertaken by listed public companies. So this is likely to have an impact on investors in listed companies. In the past, we had this slightly different scenario depending on the way that a listed company undertook a share buyback. On-market share buybacks typically dealt with completely under the CGT rules, assuming the shares are held on capital account. For off-market share buybacks, regardless of whether we've been dealing with public companies or private companies, we need to determine the portion of the buyback proceeds that is taxed as a dividend and the portion that is taxed as a capital amount. Now, what the government is suggesting is going to change is that the rules for off-market share buybacks will be changed for listed public companies anyway, so that effectively those are treated in much the same way as an on-market buyback. And what that means from an investor point of view, from a shareholder point of view, is that when a listed public company undertakes a share buyback, regardless of whether it's an on-market buyback, so company buying back shares in the ordinary course of trading on the stock exchange, or an off-market buyback, the tax implications at the shareholder level will be the same. So you will basically be dealing with that as a CGT issue. What that means is, as a shareholder, you won't receive a dividend component, which means you won't receive franking credits. Now, that's probably going to be an issue mainly for relatively low taxed shareholders, such as super funds. Receive the dividend, taxed at a relatively low rate, but get the benefit of the franking credits attached to those dividends. That's where we think the government's concerns lie and why they're thinking about making a change in this area. Now, that's not legislated yet, that's a proposal, but that is certainly one of the areas in the tax system that we may well see change. Not necessarily a whole lot you can do about it, but if you are involved in listed public companies in one way or another, as an advisor or as an investor, that is an area where we are likely to see some change moving forward. What we didn't hear about in the budget was a whole bunch of measures that have been announced in the past that are really up in the air. There's a big question mark over some of these things. For example, proposed changes to Division 7A, proposed changes to the individual residency rules, proposed changes to the corporate residency rules. These are really key issues. And we're still in the dark over what will change and when will change. And maybe we throw in there if there'll be actually a change. Now, maybe we hear more in May next year when the next full budget, normal budget is announced. But in the meantime, we just have to wait and see. So some very big question marks remain. There's really not much we can say at the moment, but we will certainly keep you up to date if we hear of any developments in those areas.
Now, across to that new draft ruling on individual residency. Matthew, what can you tell us about the new ruling?
The ATO has issued a new draft ruling on individual residency just this month, which replaces two older rulings that were issued some 25 to 30 years ago. And as you can imagine, there have been quite a few individual residency cases since then, so I'm actually quite happy that the ATO has updated its guidance to bring it more in line, especially with some of the more recent cases we've seen. Now, instead of having two rulings, one dealing with inbound individuals coming to Australia and another dealing with outbound individuals leaving Australia, what we have now is a single ruling that consolidates these principles dealing with both types of individuals. Now, it's important just to keep in mind that the four existing residency tests actually haven't changed, at least for now. So this new draft ruling is really about the ATO's interpretation of these existing four residency tests. And you can be a resident of Australia if you meet any of these four tests. It's just that the ATO does provide more clarity on when each of these four tests become more relevant. The resides test, the main test, the ATO says that becomes more relevant when you're dealing with someone who is physically present in Australia. Whether you're dealing with someone who is an inbound individual coming to Australia or an outbound individual that's left Australia but still maintains some attachments here. The domicile, permanent place of abode test, and the Commonwealth superannuation test, the ATO says that's generally more relevant when you have someone that was living here and then have gone overseas for a time. On the other hand, the 183-day test, that targets the reverse. So that's dealing with someone who's more an inbound individual. So someone that previously wasn't a resident of Australia, but have entered Australia or spent some time in Australia during the income year.
You mentioned that the new ruling takes into account some of the more recent court cases. So what's changed?
That's a great question. Especially more recently, we've seen a number of cases where Australians have failed to break residency when working overseas for more than a couple of years, while still maintaining connections and family back home in Australia. And in that regard, the ATO does still maintain its general rule of thumb that when someone is spending less than 2 years overseas, that's not normally considered a substantial period of time when you're looking at whether someone has an overseas permanent place of abode. Having said that, the ATO does still maintain that when someone spends more than 2 years overseas, that in itself may not necessarily be enough. In fact, it probably does emphasise a bit more in the draft ruling that it does depend on the circumstances, especially how well someone's broken ties with Australia and re-established those ties overseas. Also, for example, if someone is merely working overseas for a time, but they come back to Australia at intervals to resume their pre-existing established life here, so to be with family that's remained in Australia. The ATO does now comment that those individuals might still be residing here and be caught as a resident under the resides test. So whether they're also then caught under the domicile permanent place of abode test doesn't actually change the outcome. Now, the other key thing that the ATO has updated in this draft ruling is that it does now make the point when you're looking at whether someone has an overseas permanent place of abode, you're not simply looking at their attachments to a particular physical dwelling. It is a bit more broad than that. And you're looking at how someone is living and their ties to a particular town, city, and even extending to a country. And that was updated to bring the ATO's guidance more in line with the decision in the Harding case, where the court did find that someone had an overseas permanent place of abode, even though they were moving between different apartments while they were there. So in a nutshell, quite a relevant area, quite a relevant ruling, especially now that borders have largely opened up and you may find that your clients are becoming much more mobile. And it's important just to approach residency quite carefully. Not only can it determine the scope of what's caught within the Australian tax net, it can impact things like the rate of tax, Medicare levy, the availability of the main residence exemption, as well as the CGT general discount. It looks like the ATO's released some new guidance that's relevant for clients that generate income from their fame or image. Does this change the way that we need to be approaching this area?
Yes, this is an area where we are seeing some changes, and there's certainly some developments here. This is an area that has been up in the air a little bit, and it's partly because the ATO issued some guidance a few years ago now, which suggested that the tax rules could operate in a certain way when it came to dealing with someone's fame and the income that might be derived in relation to that fame. But the ATO withdrew that guidance, and it's taken a little while for us to see anything new from the ATO in this space. We now have this, which is a draft determination, where the ATO is basically commenting on whether it is possible to ensure that income relating to someone's fame can be taxed through a related entity, such as a company or a trust. And the short answer to that from the ATO is no, it's not possible. Now, how we get to that answer from the ATO's perspective is the ATO says that from a legal point of view, someone who has fame doesn't hold any property in that fame. So it's not possible for them to transfer that into another entity. So you can go and set up another company or a trust, you can have an agreement with that company or trust, but that won't be effective in terms of transferring fame or your fame into that entity. If some income is derived in connection with your fame, it belongs to you, regardless of any agreements that you've tried to put in place with that related entity. As a result, you, as the individual, will be assessed personally on that income. So that is a development that is a little bit different because in the past the ATO had suggested that some income relating to someone's fame potentially could be diverted through another entity. Now, we just need to be clear on what the ATO is talking about here. The ATO is talking about income that does relate to someone's fame. This position does not apply to income from services. So the ATO says it is possible that as an individual, you could set up a company or a trust, you could be engaged by that company or trust to provide services, and a third party could engage the company or trust to effectively relate to your services that you would then provide as an individual. The fee relating to that paid by the third party would be assessable in the company or trust if it's the entity that's genuinely been engaged to do the work effectively. Having said that, it's not quite as simple as that, because even though that income might initially be assessed in the hands of the company or trust, we need to go a little bit further than that. We need to consider the PSI rules. So if this is income relating to someone's personal skills, exertion, the fact that they've turned up at an event and made an appearance, that's probably PSI, and we need to work through the PSI tests. even if the PSI tests can be satisfied, long-standing ATO position is that if income is generated from someone's personal services, it should be taxed in their hands ultimately, regardless of the structure that's used. And if that doesn't happen, that becomes a potential Part 4A issue. So the analysis is different. At the end of the day, I think the ATO would say that whether it's income relating to fame or income relating to someone's services, ultimately, somehow, it's all going to end up being taxed back in the hands of the individual. Again, we need to be careful about this because there could be a third category, which is there may well be actual assets that can be transferred or assigned into another entity. So that could be specific intangible assets that you can assign legally into another entity. You could generate income from the use of those assets, and there would be a little bit more scope to have those amounts taxed fully inside the relevant entity, or potentially to split that income with other shareholders or beneficiaries. So again, we need to be really careful in terms of what is it that these payments are being made for. If it relates to someone's fame or services, ultimately the expectation from the ATO is it will be taxed in the hands of the individual.
What about clients that have taken a different position in the past? Do we need to go back and amend those previous returns?
Not necessarily. The ATO, I think, is suggesting that this is the way the rules work and probably is always how the rules have worked. But it's slightly complicated because we did have this older ATO guideline. It was a PCG only in draft form, which suggested that it may well be possible to divert income relating to someone's fame or image into another entity such as a company or a trust. And the ATO in that PCG actually provided effectively a safe harbour provision. And there was a 10% kind of threshold that the ATO used by way of a safe harbour. So the ATO was effectively saying that, yes, you could have a portion of income that relates to fame or image taxed in the hands of a related entity without it necessarily causing a problem with the ATO. Well, this new determination or draft determination does not support that position. But because the ATO had released that position in the past, because it's taken a while for this new draft determination to be released, the ATO has said that it will not devote compliance resources to apply the new view to existing arrangements. That will only be the case, though, for income derived before 1 July 2023, and only for arrangements that were entered into in good faith and in accordance with that old draft withdrawn PCG before the new draft determination was released. So for those clients who had effectively relied on the position in that old PCG and applied that safe harbour approach, the ATO says, look, we're not going to go back and deliberately try and reassess that income. Having said that, if, for whatever reason, the ATO needs to undertake some sort of review or audit activity relating to that taxpayer's affairs, the ATO has warned that it would need to apply what the current view is to that. So the ATO won't go looking for these cases, but if it finds them, then the ATO suggests it's probably bound to apply the way it understands the rule, regardless of whether it was an existing arrangement or a new arrangement. So you don't necessarily need to go back and amend returns. Clients could potentially, having lodged returns on the basis of that older guidance, could hopefully let things lie as they are, and that could potentially apply up to the end of the 23 income year. But beyond that, there's likely the expectation that the ATO's new view will apply to all arrangements, whether they were entered into previously or not. Now, that does assume that the ATO finalises this draft determination in much the same form as the draft version. We'll obviously just have to wait and see. These things are issued in draft as part of a consultation process. The ATO is inviting feedback. From time to time, we see the ATO then take a pretty big change in terms of its final approach. So we'll wait and see, but that's how things stand at the moment.
And that's the roundup for this month. Changes are constant for accountants and advisors. If you want to keep up to speed, then take a look at what Knowledge Shop offers. We'd love to show you how we help thousands of accountants across the country every single day. Give the team a call or visit us on the website at knowledgeshop.com.au. We'll look forward to speaking to you soon.